where I tell you guys that anything you say will be heard by people in the future. The recording is now live, so be yourself, but just remember that there is a consequence to being yourself.
Mm.
So be either yourself or the you want people to know.
Amen.
Cool. So what I'm going to do tonight is I'm going to do a quick run over of, hey, Damola, welcome. I'm going to do a quick run over of today in the markets. Very interesting day. Like I said, I'm in a trader. I just didn't bother giving you guys this one because, yeah, it was just, yeah, today was just a very interesting day. So I didn't want to get your hopes up
Is it for the
again.
Euro USD?
No. Remember I told you guys to get out of that one. I hope you did while you were still in profit.
I was trying to set up preparing for school resumption and other things. So
Okay, so you didn't get out then.
I didn't pay attention to the trades on the chart.
Okay, that's good. Good. Because we had a false alarm signal on the Euro USD. And then when the real signal panned out, I was on the school run, which is fine. But let's just look at it real quick. So the one I mean is the UJ. Let me show you real quick. So that's the trade. It's the opposite of the trade, the signal we took last week. Last week we took it on the way up to the fair value gap there. As you can see, we today got exactly, look at that precision. Can you guys see that?
Yeah.
Yeah, but Kiran, I'm sure the markets are just random. There's no such thing as a market maker. It's just supply and demand. Everything happens randomly, says people who have no clue what's going on.
Mm-hmm.
This level of precision should show you that there is a method to the madness, and yeah. So I didn't give you this one because it's a bit of a cheat from me. It follows a principle, or it's using a principle I haven't taught you yet. But all you need to know is we closed that fair value gap today. And then we've had a market structure break. If you look at this, you see there's a 1 hour market structure break. We've taken out a high from yesterday, and we broke market structure today in London. I took it on the way down. It's what you call it now. It's an Asian pair in that it uses a currency, the Japanese yen, that is going to be volatile during the overnight period because it's daytime in Japan right now. Or that's not necessarily daytime, but it's trading time in Japan right now. And so that's why I'm holding it overnight. I do expect to see some form of a retracement back into the entry position overnight, and then we'll see where it goes. My take profit is down there. I am kind of expecting it. More than likely, I will be getting out. 1 second. Kind of here is the safe place, but I want to see how it goes before I sleep tonight, before I make up my mind what I want to do. If I like the way it's going, I'll leave it in overnight. But yeah, it's risky in that it's against directional bias, which is why I didn't give it to you, because our directional bias at the moment, until we have a stop, we have a potential stop on here of a daily high. We haven't yet had a market structure break of a daily low. That would happen at this point when this blue line is crossed. So when this blue line is crossed is when, technically speaking, it should be a live trade. And then we should be looking for a retracement. But I'm just testing out something based on the next set of strategy parameters we're going to teach you. But in case you wonder why there's a trade open at the bottom of my screen, I thought I would just let you know that. So let's look at the ones that we were tracking today. The Aussie dollar, let me get rid of this first. Right, so Aussie dollar is the one that got away. So that's what we used for yesterday's teaching. Yeah, there we go. So we talked about this on Monday night, didn't we? We stop punted the daily low from. So this is Tuesday, that's Monday. This is Friday, that's Thursday, that's Wednesday. So Thursday last week, we stop hunted Wednesday's low. And then Monday this week, we market structure broke the high up there. 1 second. I'm trying to get this. Okay, let's move this away. Make that straight. Sorry. I can be semi-OCD when it comes to some of these things. If the line's not straight, it frustrates me. So from this point, as we know, what's the directional bias?
Bullish.
Bullish. So the moment we break above that green line, it's bullish. Of course, we then expect to see a Fibonacci retracement. The question is, how far will the retracement go? So if we stuck a fib from here to there, so remember we have some rules as to whether or not we take the last fib or the overall controlling low, all that. Again, new students, we'll cover that with you soon. But anyway, if you take this one, you've gone to the 61.8. We would like a discount to the 38.2, but that's still a live fib. And so yesterday we didn't get a trade because we were waiting to find out where that high would form. Eventually it's formed here. So this was the first high that gave a discount retracement. If you look at this from there to there, let me blow this up. You can see that. So we're using that high there to this low here. Remember, we want intermediate liquidity to be taken out. Well, there's the intermediate liquidity taken out. So there's the person who has cried, so we don't have to cry. Remember that?
Yes, sir.
Someone's going to cry. It shouldn't be you.
Mm.
The market maker is 9 times out of 10 going to take out an intermediate liquidity level of someone who got the direction right. So that would be an unwilling but informed liquidity. The person knows the right direction, but they've been manipulated to create a pool of liquidity. In essence, the market maker really wants to buy. They've run out of orders on this way up. So they're going to come back down here because they know what's going to be resting beneath that low there from yesterday. Sell orders from the breakout traders and a sell stop loss from the person who got the direction right, but is going to lose their trade.
Unwilling and willing.
Unwilling and willing. Anybody who took a buy here will have a sell stop loss beneath there. And the guy who's waiting for a breakout trade to the south side, to the bearish side, will also have a sell entry order there. The market maker pairs that and goes this way. Also, one quick second, I'm missing out something here. The Asian range, let me just throw that in real quick. So according to my broker server, it's 2 to 7, which is pretty much midnight to 5 a.m. in London, or 7 p.m. to midnight in New York. So you can see the parameters lined up perfectly. Kieran, I'll answer your question in a second. So you can see the parameters lined up perfectly. On an up day, what do we expect price to do first?
Go down.
Go down and find what?
Find the liquidity point. It's just a resistance.
Find a support level.
Sorry, support level. Yes.
That lines up with the liquidity profile.
Yeah.
So as you can see, this old low here, the stop hunt or the liquidity beneath it is a liquidity profile that this is tapped into.
Yeah.
And as you can see, it doesn't always follow, but we like to see on an up day the Asian range low to be violated. Remember?
Yeah.
And so you have, look at this, you have perfect symmetry. You have the Fibonacci retracement at a discount level. So that's confirmation 1. We've got into a discount level 38.2. We have the intermediate liquidity there that's been taken out. We're beneath the Asian range. See that there?
Mm-hmm.
Just as we like it to be, right, guys?
Yes, sir. Yes, sir.
Have I mentioned anything that we haven't learned so far?
Not yet.
This is all stuff we've learned so far, right?
Yeah.
And then we have the first 1 hour engulfing of the day. Can you see that right there?
Yeah.
Yeah.
That is the point at which ideally you want to get in. But if you missed it, like I did, the market did its best to help you out. That created another block. Price moved away from there, came back there, and notice it kept respecting it. Now, my plan was to get in at that level there, which is the high of that candle. I was waiting for a 1 hour candle to close above that level. This didn't, this didn't, this didn't, this didn't, this didn't. Yes, respecting means closing. Yes, yes. And in this one, I blinked and it was gone. I blinked and it was gone. So I didn't chase the price. But as you can see, perfect price action. To answer Kieran's question, where would you place your stop loss? Well, you got two places to place your stop loss. If you remember the trade, or the, what's it called now? The trade model. The first place is beneath the engulfing, which would make it a what? That would make it a scalp, right?
Yeah.
And then you're holding for a minimum of what?
2 to 1.
2 to 1. If you've done that,
definitely got like 2 or 3 to 1 here.
20 pips, you would have gotten 2.5 to 1, which would have been within the boundaries of the parameter. The other safe play, or the safer place to keep your stop loss would be where? Beneath the Fibonacci low, right?
Yeah.
Now that's 46 pips. To do that, you would have to be holding for one of these targets. Now, if you got in there, put your stop loss there, that's 46 pips. Now you're looking for minimum of 3 to 1, right?
Mm-hmm.
Target 1 wouldn't even give you 2 to 1. Target 2, however, would give you pretty much just about 3 to 1. So if you're taking this safe entry, you have to be holding for target 2.
I mean, about 2 or 3 days.
Does that make sense? Because it doesn't make sense to take a trade that will not give you at least 3 to 1, except you're scalping. You take 2 to 1 when you're scalping because you're going to get far more entries, so the losses will be balanced out by the profits. However, if you are going to take a proper intra-week trade, minimum 3 to 1. This is one of the things that made me a little bit indecisive about AU, because this target 1 didn't offer me 3 to 1. So I knew I had to scalp it. If I had to scalp it, meaning if I was going to put my stop loss beneath that low, I needed confirmation that this was moving. And it stalled for about 5 hours straight before it took off. I got tired of staying on my computer. I walked out to my study to go do something for 20 minutes. I came back, boom, it was gone. And it never came back. EU, on the other hand, was an interesting one. Now, if you remember at the start of the day, I drew out this line. We were here at this time. One second. Let me see if I can just find that on Telegram. Right. You can see, you guys can see the Telegram group, right?
Yeah.
Okay. Yeah. So first of all, started off the day as I like to do. Remember, where are we in price? Well, we've had a 2-month consolidation, a break above here, a break beneath here, and now a retest. If we're going down, remember CMERT, consolidation, manipulation, expansion, retracement, target. Remember that?
Yeah.
Price moves from consolidation to consolidation. Remember?
Yes, sir.
1 second, Kieran, you said a lot when price reaches certain levels. Yes, I do. I do, especially if I'm going to be out of away from my chart for a while. Yes, I do. But the alert wouldn't have helped me anyway because I was in my house. I can't remember. I think I went to go, I don't know, grab a drink or get something to eat, whatever it was. I can't remember what it was. I came back and it was gone. But yes, if you are waiting for a trade, you can actually set an alert that tells you when price gets there. So price moves from consolidation to consolidation. Remember that. So looking at this chart, for instance, there's a consolidation down here, then it moved into this one. Then there's a consolidation in the middle here. Now it's moved into this one. So we played a game of poker chicken for 2 months. Are we moving up or down? And we kept having a range. There was no clear market structure break stop hunt on a weekly basis in either direction. We finally had one last week. And now price is coming up to retest this consolidation. See that there?
Mm-hmm.
That is what's going on here. 1 second. Where is that chart? Where did I put it? Oh no, that was on my laptop. That's fine. I'll just open up a new one here. That was on my laptop. So that's here, right? That's the high of the consolidation roughly. That's the low of the consolidation roughly. MetaTrader 4 is getting on my nerves again. There we go. And so we would expect it to come back, remember, to roughly the middle, somewhere around the middle of that point. Well, that's what this trade is doing right now. It's coming back to test this consolidation. And if it is going to go south, we should get a daily engulfing somewhere in that range. Well, this is my concern with EU. Let's go to AU. It's a lot cleaner in this sense. We know that we have two targets and they're both fair value gaps, which we're going to look at over this next 2 weeks when I get to tonight's class. So that's one fair value gap there, like we looked at yesterday. And this is another one here. So these two lines here are the target 1 and target 2 of the AU trade. Let's look at it here. You see that? Target 1, target 2. You see that, right?
Yeah.
Yeah.
Well, these are the lines here. Look, that one and that one.
Okay. Those are key levels.
You see that? That's identical to what we have here.
Yeah.
Now, this is the problem. One quick second. So this is the problem here. So I'm a bit skeptical. That's why I was like, just close that trade. That would be this line here. Target 1 would be this line here, right? Can you see?
Mm-hmm.
Mm-hmm.
But we're there already. So this candle will be the first fair value gap that we broke beneath. But we got there yesterday and again today. And then it starts to dance around. So again, like I told you guys, I am not a gambler. Been there, done that. I know you guys enjoy trading for the sake of it. Good. I don't anymore. I like trading to win, right? So I would much rather pull out of a 50-50, even if it wins, and look for a sure banker, especially with my live money. Demo account, yeah, cool. Let's see how it goes. If I'm trading live money, you better believe that I'm not. So I want to see what happens tonight and tomorrow. But just taking the trade on face value, let's go back here. So drew out that line in the morning, remember? And I said, I want to see what happens around it. Why? Because when this formed, look, this low and this low are pretty much equidistant, aren't they?
Yeah.
Can you guys see that?
Mm-hmm.
Let's go back to the chart of the group. Remember that this morning? See that there?
Yeah.
Yeah.
Right. And what? So draw that blue line. Okay, 1 second. Oh, I didn't. Okay, anyway. So what do you think is going to be resting beneath that line here?
Liquidity.
Somebody put your hands together for Ivy. There is going to be a liquidity pool, POOL, that is going to cause a what?
Liquidity pool. PUL.
PULL. Now, I waited for that. Again, look, 1 hour, 2 hours, 3 hours, 4 hours, and eventually thought, okay, maybe they don't want to go there. Now, if you, again, Fibonacci, high to low, actually, this is the one I used. Why? I'll explain as you go on in the course, how you know which one to use out of all of them. So see, this is just tapped into the 50. And I was waiting. London, nothing. The beginning of New York, nothing. And so I finally thought, okay, maybe they do just want to go from here, right? And so when this candle broke above that level, this candle, sorry, here, this is when I gave the signal. Put your stop loss here. Remember I said short leash, if that candle doesn't close decisively, get out. Remember?
Mm-hmm.
Well, this is what it looked like when I gave the signal. This is why it's good to look at price action retrospectively, not just see what it looks like at the end of the day, but how would it have formed, right? So, no, that's AU. That's AU. Where is that signal? This one here. There we go. So this is what it looked like when I took the trade. Can you see that? When I gave you the signal, it was on its way up. It came down and I took it literally as it was flying up. I just put an order there as it was flying up. Can you see how this looks like a good trade at this point?
Yeah.
Yeah.
If you took this trade and you saw this, would you be happy?
Nope.
Yeah.
I would. Everything
Yeah.
looks good. That's your entry and the candle looks like it's flying up. That's why we wait for the candle to close. Right? That's why we wait for the candle to close. So by the time that candle closed, it closed like this. Ladies and gentlemen, this is the exact same candle that just looked like it was flying. It closed like this. Come on. It closed like this. That white candle there. Can you now see why I said get out?
Mm-hmm.
Can you now see why I said get out? Yes, no, maybe. I want to explain if you don't get it. Does everybody understand why when that candle closes that way, you might want to get out of that trade?
No.
Did it engulf? Now, it did in terms of halfway through, but did it close as an engulfing of this candle? Did it close as an engulfing of that candle there? Somebody answer me. Come on.
Was engulfed.
We're waiting. We were
Yeah.
hoping that it would engulf this black candle, right? When it closed, did it close above the engulfing line?
Yes,
No, it did not.
it didn't.
This is the close here.
No, that's like it's not a doji. I was gonna
Did this white? It's a spinning top.
Yeah.
Did this white candle close above the high of that black candle?
No, it closed below it.
No.
Beat it.
Yeah. Now, halfway through the hour, it looked like it was. Look, it came all the way up here, right?
Yeah.
But then it came back. Something drove it back down in there.
You're talking
That-
about the body. The body should engulf the other body.
Yes, the body should engulf the other candles high. But in this case, it didn't even engulf. You're right. You're right, Tox. It didn't even engulf its body. Look. It didn't even engulf the body, much less the high. Now, remembering this is where experience comes in, discernment or discretion, I should say. Remembering that I have a manipulation level just beneath that I've already drawn out. My spidey sense kicked in and said, if they did that, they're coming for this. Right? That was the reason for the get out. Did they come for it? Did they come for it, guys?
Yeah.
Yeah.
Did they come for it?
Oh,
Yes.
Did they come for the liquidity here?
Yes.
Yes, they did. So you have to understand how the market works. You can't just tell you when you see this indicator, take the trade. No, this is where the understanding of the principles comes in. You know, you are just above a likely manipulation level, right?
Mm-hmm.
And then this happens. Price keeps staying in that range. It looked like it was going to go up. It came back down, right? Then here again, the same thing came back down. Why are they refusing to leave this level? What is so special about this level? What about this level doesn't or won't allow price move? The answer is simple. There is a liquidity pool just beneath it.
POOL, right?
POOL, which is going to cause a liquidity PULL.
Yeah.
And so I just thought, you know what, get out. And now could this have gone up and you'll have been, man, yes, it could. But I'd rather have the peace of mind. That's just me. That's a decision you have to make as a trader. What do you prefer, peace of mind or extra profit? You guys looked at my journal. What did I write I prefer as a trader?
I prefer
Peace of mind.
That's me. Now, there's no right or wrong answer. I just like peace of mind. Simple. You might be the kind of trader who says it's only 1%, whatever. That's fine. Nothing wrong with that, as long as it's a calculated risk. So if you do lose the trade, you don't bang your head on the wall. You knew what you were getting into. You knew there was a high chance of that happening, but you were ready to just test it out, because if you won, you'd win 4-1. So over the course of time, your wins will balance your losses. But just bear that in mind. Of course, I went for the school run. My sons finish school at 3 p.m. London every day. Interesting. Very interesting, isn't it?
Same as New York close.
Say that again.
Same as New York close.
Yep. What the closing of the New York strike zone. I'm going to show you that in a second. I'll show you that later on in our course. So those are called strike zones. I call them strike zones between 6 to 10 and 11 to 3. Now, if I have to get to my son's school for 3, I need to leave my house at about 2:30. This candle here formed at 3. And then the very next candle. The truth of the matter is, even if I had been there, would I have taken this trade? Probably not.
Nope.
I don't think I would have taken it, is the honest truth. And this is why. First of all, stop loss would have been too wide. 31 pips is not that bad. But then secondly, it's past 3, right? I know we're about to enter the CBDR. Look, the CBDR starts here. Unless I was scalping, and if I was scalping with a 30 pip stop loss, I would need a 60 pip gain for the trade to make sense, right? Well,
Yep.
60 pips from here would be this level here, which I think they're going to go for. I think the signal I gave that I pulled was supposed to clear this level here into that level there. However, it's already 4 p.m. in the afternoon in London. Central bank dealers range. Damola, I'll get you the videos for that, or you come across them as you work through the playlist I gave you. You'll come across it eventually. It's in the playlist that you got in your induction letter. Central bank dealers range. It starts between 8 p.m. to 2 a.m. No, 8 p.m. to midnight. No. Sorry. Let me get my facts straight. 8 p.m. Sorry, 6 p.m. to midnight here in London. Yeah, so 6 p.m. to midnight here in London, central bank dealers range. So this is one of those ones where if this is going to keep going up, just draw that line out. I can almost guarantee you, if we are going to go up tomorrow, if tomorrow is going to be an up day, there's going to be an entry beneath that line at some point in London or New York. Right? So just stay away. This is the kind of trade you just stay away from. When it starts, you just stay away from it, because you could be caught on the wrong side. Anyway, so that's, yep. That is today. So what I'm going to do now is I'm going to, one second, I'm going to stop the YouTube recording here now for this to be an end of day review.